Have you ever wondered how a company, say a giant like Apple, accounts for a big investment it has in another tech firm? Or how a factory actually calculates the value of a brand new $1 million robot? Well, it's not as simple as just looking at the price tag. There's a whole set of rules that tell the financial story of a business. So let's dive right in and explore how companies value everything, from their slice of other businesses to the very ideas that make them unique.
First, we'll look at what happens when one company invests in another, enough to have some real influence. Then, we're going to get physical and talk about assets you can actually kick, like buildings and machinery, and break down how their value gets recorded over time. And finally, we'll get into the really tricky stuff. How in the world do you put a price on things you can't even see, like a brilliant patent or a world-famous brand?
All right, first up, investing. What happens when a company buys a big chunk of another business? We're not talking about a full takeover, but enough to get a seat at the table, enough to have a real say in how things are run. This is where the accounting gets pretty interesting.
So here's the deal. The accounting rules totally change based on how much of a company you own. If you own less than 20%, you're basically just a passive investor. If you go over 50%, you're the one in control. But there's this fascinating zone right in the middle, from 20 to 50%. That's what accountants call significant influence, and it kicks off a whole special set of rules called the equity method.
Now, significant influence doesn't mean you get to call all the shots. Not at all. It really just means you've got a voice. You have the power to be heard when major financial and operational decisions are being made. And that 20 to 50% range, that's the magic number that tells accountants, okay, it's time to use the equity method.
So how does this method actually play out? The best way to think about it is like a living, breathing number on your balance sheet. You start with what you paid for the investment. Then, when the company you invested in makes a profit, the value of your investment on your books goes up. If they take a loss, your investment value goes down. But here's the twist. When they pay you a dividend, it's not considered income. Instead, the rules see it as them just giving you a piece of your own money back. So it actually decreases the value of your investment.
Okay, let's make this real. Let's say Company P shells out $200,000 for a 30% piece of Company XYZ. On their books, two things happen instantly. Their cash balance drops by $200K, and a brand new asset called Investment in XYZ pops up for that exact same amount. That's our starting line.
Now let's watch this number move. In year 4, XYZ has a good year and earns $100,000. Company P's share is 30%, so that's $30,000. Boom! Their investment in XYZ asset goes up by $30K. A little later, XYZ decides to pay out $20,000 in dividends. Company P gets their 30% cut, which is $6,000 in cash. But remember the rule. That's a return of their own capital, so the investment in XYZ account has to go down by that same $6,000. The value is always in motion.
Okay, enough about owning pieces of other companies. Let's talk about owning our own stuff. You know, the big, tangible, physical things a business needs to actually do business. We're talking about its property, its plant, and its equipment, or what accountants call PPE.
PPE gets put on the books at what's called historical cost, and this is a really key idea. Cost isn't just a sticker price. It's the purchase price plus every other penny you had to spend to get that asset up and running. Think shipping fees, installation charges, testing costs, anything and everything to get it ready for its intended use.
But what about money you spend on an asset after you've bought it? Well, if you spend money that makes the asset significantly better or makes it last longer, like putting a brand new engine in an old delivery truck, that's a capital expenditure. You add that cost to the asset's value. But if it's just routine upkeep, like an oil change for that truck, that's a revenue expenditure. You just treat it as a normal expense for that period.
Let's go back to that robot from Jayhawk Co. The price tag was $850,000, but it cost another $150,000 to get it installed and properly tested, so its total historical cost is a cool $1 million. But wait, they figure they can probably sell it for parts for about $100,000 at the end of its life. That's called the salvage value. The total amount that they'll actually expense over time, the depreciable base, is the difference, $900,000.
So now you have this $900,000 cost. You can't just write it all off as an expense in year 1. That wouldn't make sense, right? The robot is going to be helping you generate revenue for years to come. Depreciation is simply the process of spreading that cost out over the asset's useful life, trying to match the expense with the revenue it helps create.
The simplest and most common way to do this is the straight line method, and it is exactly what it sounds like.
You take that total cost, you divide it by how many years you think the asset will be useful, and you expense that same amount in a straight line year after year. It's simple, it's predictable, no surprises.
For our robot, you take that $900,000 depreciable base, you divide it by its 5-year useful life, and what do you get? A nice, clean depreciation expense of exactly $180,000 every single year. And you can see here how the carrying amount, which is just the original cost minus all the depreciation so far, drops by that same amount each year until it hits that $100,000 salvage value.
But hang on, what if an asset's value has less to do with the calendar and more to do with how much you use it? For that, we've got the units of output method. This is perfect for things like machinery or vehicles because it ties the depreciation expense directly to activity, how many widgets the machine makes, or how many miles a truck drives.
Take a look at our robot again. In year 1, it was working like crazy, cranking out 2,300 units. And look at the depreciation expense. It was huge, over $258,000. But fast forward to year 5, when production slowed way down to only 700 units, the expense was tiny, just over $78,000. The expense literally mirrors the workload.
Then there's another school of thought. It says that assets are way more productive and valuable when they're brand new, right? That's where accelerated depreciation comes in. These methods front-load the expense, so you recognize more depreciation in the early years and less as the asset gets older and presumably less efficient. It also has the nice side effect of lowering your taxable income earlier on.
Here are 2 popular ways to accelerate depreciation. On the left, you've got the declining balance method, which starts with a massive $400,000 expense in year 1. On the right is the sum of the year's digits method. Now, the math behind them is pretty different, but you don't need to sweat the details. Just look at the pattern. For both of them, bam, the biggest expense hits right at the beginning and then it shrinks every year after that. All right, so we've covered owning parts of other companies, and we've covered physical stuff. But what about a company's most valuable assets? Often, they're the ones you can't even see or touch. Let's talk about intangible assets. So what exactly is an intangible asset? Well, it's something valuable that has no physical substance. Think about the legal protection of a patent, the incredible brand power of a trademark like the Nike swoosh, or the creative ownership of a copyright on a book or a song. For so many modern companies, this is where the real value is.
And this brings up some really tricky questions. For instance, let's say your company owns a patent and a competitor tries to copy it. You spend a fortune on lawyers to defend your patent in court. So is that legal bill just a regular business expense for the year? Or did you just do something to make the patent itself more valuable? Well, it turns out the answer depends entirely on whether you win or lose. If you successfully defend the patent, those legal costs are capitalized. That means you add them to the patent's value on your books because you've just proven how valuable and secure it is. Then you expense that added cost over time through something called amortization. It's just like depreciation, but for intangibles. But if you lose the lawsuit, those legal fees are just an expense for the period, and you probably have to write down the value of your now worthless patent.
All right, pop quiz. Let's tie this back to where we started. Larkin Co. owns a 25% stake in Devon Co., and they started the year with that investment valued at $200,000. Devon has a killer year. They earn $600,000 in net income and pay out $400,000 in dividends. So what's Larkin's investment worth at the end of the year? Well, let's do the math. You start with the $200,000. You add Larkin's share of the income. That's 25% of $600K, so $150,000. Then you subtract their share of the dividends. 25% of $400K is $100,000. And that leaves us with a final carrying amount of $250,000. So from the equity method for investments to the different patterns of depreciation, these rules give us a structured way to put a value on a company's assets. But it leaves us with a big, important question to think about. In an economy that's more and more driven by code, brands, data, and ideas, are these accounting rules, which were largely built for a world of factories and machines, still telling us the full story of what a company is truly worth?